Okay, let's get more on today's market action and investment strategy. We're joined now by Jack Ablin, Chief Investment Officer and founding partner at Cresset Capital. Jack, great to see you. One market indicator that you and a lot of pros watch closely is liquidity. Could you just remind us what liquidity means in this context and what are you seeing?
Sure. Nice to see you again, Andrew. So liquidity is just one of the metrics that we track. And liquidity is really the availability of money to borrow, spend, and invest. In many respects, liquidity is like the circulatory system of the economy. The faster it flows, the easier things are to get accomplished.
And sorry, Jack, what is the pattern you're seeing right now in liquidity? Does it bode well for the market?
Sure. So it has withdrawn a little bit. One of the metrics we watch is the yen. That's generally been the source of a lot of carry trade activity. Mm-hmm. The yen is still cheap, reflecting an active carry trade going on. If these traders start to sense more trouble, they would buy back that yen, have yen values rise, and that would be something that would suggest weaker liquidity. But for right now, the yen is very strong. The other metrics that we track are volatility, stock and bond market volatility. If you think about margin lenders, they tend to withdraw their loans and less likely to lend against more volatile assets. So that tends to withdraw. And we are seeing volatility certainly at the higher end of the range. So the chart you're showing here is really credit spreads. This is the yield premium that lenders require to extend credit to BBB borrowers. And what we track is the 200-day moving average of that spread, and then a buffer that's 10% above that 200-day moving average. What we have found is when yield spreads rise above that 10% buffer, that moves us into a risk-off position, and that's really been a very useful indicator of market risk in general.
So bond, you note that bond investors, they're in a market that's much bigger and they tend to be smart. So is that a good sign for the economy?
Right now, no. Good news is from a nominal basis, yield spreads are still very cheap by historical standards. But what we're starting to see relative to that 200-day, which of course continually adjusts, that break point is closing in, and we just want to pay very close attention, because I think if we do break that to the upside, and there's no certainty that it will happen, that could be a signal for us to perhaps reduce some equity risk.
Just give us your thoughts on GameStop. Some have dismissed it as a meme stock, a gambling token. It's trading at a big premium to the value of its cash. Now it's getting into Bitcoin.
That's it. It's doubling down on that memedom. It's definitely a Reddit darling, and it's just playing right into that crowd by shifting its reserves into Bitcoin, just like MicroStrategy did a few months ago. So I'm not a surprise to see speculation rising in GameStop.
You have some stocks for us, some stock ideas. Start off with Chevron, a dividend yield north of 4%.
That's it. The theme here, Andrew, is I want quality companies so to be able to withstand an economic downturn, but we also want companies that have persistent dividend growth over time. So Chevron, certainly one of the persistent dividend growth darlings, paying a 4.1 dividend yield, been growing and is expected to grow its dividend at 5.2% per year for the next 3 years.
McDonald's, a smaller dividend, maybe 2.3%, but you like the look of this one.
We do. Again, high quality company, certainly has had its ups and downs, but again, 2.3 dividend yield, but growing its dividend at 5.5, expected to grow its dividend over 5%.
And finally, Johnson & Johnson, a classic blue chip. They went through litigation challenges there with the talc and their baby powder, but you like the long-term look for J&J?
Yeah, again, high-quality company, low debt, high cash flow yield, dividend yield of 3.1, growing its dividend at about 5. also a pretty good, pretty good player. And if you think about these three companies, rarely are they going to get mixed up in any kind of tariff tiff. And so we're kind of trying to stay away from the industrials and some of the other and some of the tech that could get caught in this trade war.
Have you ever seen a period in which the federal government, or I mean the administration in particular, has been so unpredictable?
Well, Trump 1.0 was pretty unpredictable. And if you dial back to that period between 2016 election, 2017 inauguration, the pattern of returns of various asset classes were almost identical between 2024 and 2025. What's interesting to note, Andrew, though, from that inauguration day, 2017, through the end of the year, best performing asset classes, while equities did all right, international did very well and China did remarkably well, sort of reversing the course of that election to inauguration pattern.
Sorry, give us that again. So you said in his first term and this term, we've seen a similar pattern?
Similar pattern between election day and inauguration day, whereas U.S. up, international down, China getting hammered, Mexico getting hammered, gold doing pretty well. And then from inauguration day to the end of the year, 2017, international outperformed the U.S. and China was the best performing market, up 42%. Now, I'm not suggesting that China is going to be up 42%, but I do think that this international pattern running counter to this period between election day and inauguration day, kind of reversing itself for the remainder of the year.
Always great hearing from you, Jack. Thank you very much.
Thanks, Andrew.
Jack